Hello and welcome to Risk Talks. My name is Edward James. I'm the founding director of RCQ Associates, the risk, credit and quantitative specialists. Today, I'm keen to introduce Francesca Fraulo. She is an ex-director of Fitch at Fitch. She was an ex-managing director at CRIF Ratings, and she's the founder of SustainAdvisory. Hello, Francesca. How are you?
I had fine, and thank you very much for having me.
No, it's been my pleasure. We look forward to talking today about sustainable investments, ESG, and the rating space. So without further ado, how has the increase in ESG investments impacted the rating agency industry?
ESG investments are booming, and so is the market for ESG data and data providers. According to recent research by Morningstar, sustainability-focused funds doubled in the past 3 years. The counting at the end of the second quarter of 2020 reached 534 ESG funds with asset under management above $250 billion US. The largest market remains Europe with 3/4 of global assets. So indeed, a big market. The surge in demand for sustainable investments in Europe has accelerated very quickly over the last 3 years, following the introduction by the European Commission of the Sustainability Regulation and the adoption of the UN Sustainable Development 2030 Agenda. As a result, many policies have been introduced with the intention to clarify fiduciary duties and increase transparency in the field of sustainability risks and investment opportunities. Therefore, those policies are contributing to reshape and broaden the activity of some core financial service providers, especially credit rating agencies. ESG data and ESG data providers have been traditionally provided by sustainability rating agencies or dedicated ESG data providers. Today, with the advent of the sustainability financial disclosure regulation, credit rating agencies are also required to include and disclose in their analysis the impact of ESG rating factors on the creditworthiness of issuers. This regulatory provision is has affected the business model and the strategic focus for most credit rating agencies as far as competencies, products, research, and market coverage. So big impact.
Yeah, we've seen a really big change in both the ESG and the credit ratings approach to ESG. So yeah, it's been high profile and a really interesting area. So yeah, Francesca, in your opinion, how are credit rating agencies coping with the new ESG market paradigm?
Well, the evolution of investors' demand for ESG analytical content has driven a double-digit growth for ESG data market and has triggered a fast consolidation of the market, but also has fostered the emergence of new high-tech ESG data providers. The lion's shares of acquisition, we all know, has been made by the large credit rating agencies. So we've seen S&P Global acquiring Bookmarks, Moody's acquiring by JRS, Morningstar, the BRS taking over the majority of Sustainalytics. This is really a fast-track strategy for credit rating agencies to cope with a surge in demand. However, this is not all, and I think the expansion of analytical teams and competencies has not exhausted the task that credit rating agencies need to complete to keep up with the investors' expectations. There's a nice report called Who Rates the Raters by Sustainability, and the 2020 edition reveals that the investors believe that rating agencies have a lot of work to do in this area, integrating ESG information in their methodology. They ask for improvement of comparability, consistency, quality and disclosure, focus on materiality and linkage to financial performance. So indeed, it's not over from rating agencies, and they will continue to work hard to improve the offer in this topic.
Yeah, I think there's been some interesting sort of work and changes going on here. I'm certainly seeing from certainly the big three credit rating agencies, there seems to be a lot more talk about ESG topics, and all of them have taken slightly different paths to where they are today. But yeah, I attended one of the Global Credit Outlook's meetings earlier this year before COVID prevented travel restrictions. And I noticed there were quite a large number of investors in the room who were for one of the ESG talks, and I thought it was really interesting what they had to say. But yeah, so in your opinion, how are investors upgrading their analytical skill sets to cope with ESG investment challenges?
Well, it's interesting because what emerged from this same survey I mentioned before is that investors seem to prefer to develop in-house expertise to build more sophisticated and nuanced ESG strategy. Therefore, ESG ratings are used primarily as benchmarks and one of the many metrics used to build up strategies. Is it worth saying, though, that the universe of sustainable funds is wide, and strategies can vary a lot from exclusion only, broad ESG, or thematic, and these ones are specifically can be very much directed towards climate change or social or any environmental topic. So it's huge, the amount of data investors can require, and this is why what we see is that investors are moving towards a request for ESG raw data more than ESG ratings. So a kind of a shift in the profitability also of sustainable rating agencies and data providers, moving from the sale of ESG rating, top line ratings, into the sale of raw data, making raw data an extremely valuable asset right now.
Yeah, I think, I mean, we just have to look at the valuations of tech companies. Although I say that with the caveat, we look at the valuations of tech companies today, and someone might be viewing this in the future and they might have bombed, but let's see. Yeah, it's really interesting seeing mergers, acquisitions within this sector. So in your opinion, how will credit rating agencies, will credit rating agencies replace the sustainable finance specific rating agencies or the ESG providers? Do you think there's going to be some replacement or changes, or how do you see things?
Sustainability rating agencies and credit rating agencies have quite different roles and missions, but also some intrinsic similarities. First of all, credit rating agencies are subject to regulatory supervision, while sustainability rating agencies are totally unregulated players. Secondly, the basic information that credit rating agencies use are corporate financial statements, while underlying data for ESG ratings are non-financial information related to environment, social, and corporate governance topics. But the concept of sustainability is key for most of credit rating methodologies, even though it's specifically tailored to financial performance and implication of a company's activities rather than to its wider economic, social, and environmental context. So going back to your question, I don't see a case for replacement of these two players, but I see sustainability as an equation with many multiple unknowns, and therefore a strong rationale for the integration of complementary competencies and the opportunity for a credit rating agency to expand their business model, and especially to innovate the way they use analytical tools. And this is a point I really want to stress, because the ESG data universe is vast, as we just said, and data are mostly managed with technologically advanced applications like big data, artificial intelligence, machine learning. Credit rating agencies, analytical toolkits have been changed truly little recently and only driven by compliance-based requirements. So I think it's time for credit rating agency to embrace technology and make it more relevant within the analytical team skill set. So I think in this respect, integration with sustainability or ESG data providers will be extremely beneficial for them.
Thank you. So I noticed, I picked up on one thing that you said there, it's about innovation. So I know there's been quite a lot of innovation within this this sector and world, and obviously it's constantly changing in terms of how we approach these topics. And I've noticed there's a number of, or there's some changing regulations going on. So can you talk me through how policies and regulations evolving, and how will the rating industry be affected by this?
Yep, indeed, regulation is pretty key here. The European supervisory authorities have been recently introduced sustainability in their mandate as an integral part to promote integrity and stability of financial markets. So EBA, ESMA, EIOPA, the three European supervisory authorities are indeed very keen in sustaining the renewed sustainability finance strategy. And in the feedback they given in July to the current ongoing consultation, they gave out a very strict indication about what's going to be the future of ESG rating, because they believe that the role of ESG rating, benchmark, and ecolabels will be subject to EU level supervision, and therefore the Sustainability Rating Agency will be soon subject to some sort of regulation to ensure the consistency and transparency of the methodology they apply. I think I would like to stress the difference between sustainability regulation and financial regulation, because on the other hand, I don't see still a change for the use of rating services in the EU financial regulation as far as the need for integration of ESG factors, because credit ratings used in the calculation of the capital requirement for credit institutions, according to the prudential regulation for financial institution and insurance, will stay and will remain for a bit of time risk-based creditworthiness. Despite the expectation and lobbying for the introduction of a green discounting factor, which I'm sure you've heard in the many conferences you've attended, the prudential regulation, central banks and the prudential regulation will continue to support an evidence-based risk assessment. And they will continue to do so in absence of overwhelming evidence supporting the correlation between sustainability and creditworthiness. The risk-based approach won't change for sure.
Great. And also, there's some really interesting answers there and points. So I've seen a few sort of trends moving. I guess we've talked about the high-profile nature of the ESG markets, but I'd be interested to know actually what trends have triggered the current interest in sustainable investment. So I guess why now? And also, if we're looking at it from a purely financial services industry perspective, what implications do you see for the financial services industry for this particular area?
Yeah, I think the task of addressing sustainability issues, and primarily those affecting climate change, is driving a major and secular change that it won't be imaginable without the global commitment and comprehensive coordinated effort of private sector, public sector, government, citizens. This is why I'm so passionate about. It's not a task for a single industry, but the financial industry plays a significant role to meet sustainable development goals set by the UN in the 2030 agenda. Until a while ago, though, I witnessed the proliferation of initiatives without any coordination. What I see recently is a greater effort to join and coordinate forces at all levels. Therefore, I think consolidation will continue in the ESG space. Regulation and policies will continue to pursue a standardization effort and transparency effort, which are so key for the financial sector. I think in this respect, the huge effort put out with the drawing of a European taxonomy is a testament to this path. But also the cooperation and partnership between GRI and SASB, which are the two major global standard setters for non-financial standards, I think are really signing a path towards consolidation and a single effort of all parties involved. So I think sustainability, as far as the financial industry is concerned, requires a different business mindset, inclusive, open to diversity, transparent, cooperative, a different way of working, and people, professional and organization that will embrace this concept will be the ones succeeding in new paradigm.
Great. No, it's been lovely hearing about this. And one other question I had for you, Francesca, is I know you founded SustainAdvisory. So first of all, congratulations on taking the step into your company. And I'd just be quite interested to hear a little bit about the work you're doing at SustainAdvisory. Can you, for someone who doesn't know too much on this side of things, so can you sort of talk me through what exactly you're doing and what SustainAdvisory does, please?
Yes, I'm very happy to do so. SustainAdvisory is a management consulting providing ESG related advisory services in like ESG ratings, non-financial reporting, but also we work with experts in various areas of competence to develop topic-specific sustainability indicators for thematic investment and investors. So very much not far away from what I just said about ESG data providers in a much more limited space, but with big ambition.
No, that's lovely. Well, it's lovely to hear about this. It's also been really nice to hear your thoughts. It's been really insightful about just hearing about rating industry, ESG, sustainable finance. I know everyone's talking about it so much more. So yeah, I'll just say, look, thank you so much for taking the time, Francesca. If for anyone who's still got to this point, you'll be able to see Francesca's LinkedIn profile in the notes below. Yeah, thank you so much. Please do follow me on LinkedIn and for any other episodes of Risk Talks. And again, thank you so much, Francesca.
Thank you very much.
That's been really kind of you. Goodbye.